Morning, guys. It's Wednesday, September 17th, 5:25 a.m. Central Time. Grain market's just a little bit lower this morning. December corn futures down 1.25 at 428.25. November soybeans down 3.5 at 1046.25. December Chicago wheat down 1/2 cent at 533.5. December Kansas City wheat down 1.25 at 522.25. December spring wheat down 1/2 cent at 576. We got some currency news to start off this morning.
So the US dollar tumbled on Tuesday, hitting a 4-year low against the euro and a 1-month low against the yen on expectations of a potential rate cut this week. Additionally, the US dollar index fell 0.7% to its lowest level since early July, with labor market conditions softening. Markets widely expect a 25 basis point cut today and are bracing for a dovish message from Fed Chair Jerome Powell. But with retail sales data coming in stronger than expected yesterday, the Fed may take a more gradual approach to cutting rates. Earlier this week, the markets were pricing in a nearly 80% chance of 3 or more rate cuts before the end of the year.
The Fed announcement regarding rates will be out this afternoon. Based on Treasury markets, there is a 96% chance that we'll see a quarter point cut today. Beyond that, I don't really know. The Federal Reserve, we'll start here. The Federal Reserve has two mandates. A dual mandate is what they call it. They care really about two things: maximum employment and price stability, which is inflation. So they care about the labor market and they care about inflation. The Fed now feels, despite the fact that CPI is still running too hot, I would argue, in the upper twos. I think it was 2.8 or 2.9 last print. They believe they've got inflation under control, and they're now looking at a labor market that is deteriorating slightly. The unemployment rate ticked up to 4.3%, which is kind of the highest that we've seen in this like lower unemployment post-COVID environment. So they're getting a little bit concerned about that. And I think that that's why they're going to cut today, despite the fact that so many assets and so many things are just screaming red hot in terms of valuations and pricing. The U.S. dollar and a weak U.S. dollar is considered to be a positive for the commodity markets because there's two reasons. One of them is because it makes our products a little bit more competitive on the export market. But the bigger thing in a lot of instances is just sentiment. If the dollar's weak, the funds and large speculators become a little bit more interested in owning commodities. This version of the dollar index that everybody tracks is very much antiquated. It's the euro, the yen. I've got a typo there. It's the Great British Pound, Canadian dollar, Swedish krona, and Swiss franc. They should really include some of our other big trading partners, like perhaps Mexico or China. Maybe those currencies should be included here. But in any case, the dollar is weak. As far as corn and soybeans are concerned, the dollar Brazilian real relationship is by far more important. The U.S. dollar is down 14% year to date versus the Brazilian real. And just this week, it's down a couple percentage points, or this month, rather, we're down 2.5%. This is a big deal. U.S. soybeans are competitive versus Brazil on the export market right now. Other global buyers, aside from China's avoiding U.S. beans because they're fighting the trade war. But other global buyers have stepped up and they've begun to buy United States soybeans because they're cheaper than what Brazil has to offer. That's a seasonal thing also. You know, Brazil's going to start planting. Some of their old crop supplies are, I wouldn't say becoming exhausted, but they're not as readily available as they once were, whereas the U.S. is getting into this harvest window. As far as commodities as a whole, I pulled a Bloomberg Commodity Index chart, and it's up 1.8% this month, up about 6% year to date. A lot of this has to do with the rally that we've seen in the metals, like the gold market, which we're going to talk about in a little bit, and also the livestock market. You look at things like grains and energies, not really so much. But I think that this absolutely, the weaker dollar had something to do with yesterday's little bounce in the grain markets.
A U.S.-China trade agreement could be reached soon, as Treasury Secretary Scott Bessent said yesterday that more trade negotiations are on the way. If no agreement is reached, President Trump's reciprocal tariffs on China will take effect on November 10th, imposing a 34% tariff on Chinese goods with additional duties that could raise the effective rate to between 50 and 60%. Last year, the U.S. recorded a trade deficit of nearly $300 billion with China. According to Bessent, that deficit will shrink by at least 30% this year and more in 2026. China has yet to purchase any U.S. soybeans for current marketing year delivery.
We'd love to see a trade deal. I could envision a situation where they kick the can down the road again, and it's like, hey, we're going to meet again in 2 months or something like that. But the market, I think this is another part of the reason that we saw a bounce in the markets yesterday, and corn, soybeans, and wheat all finished higher. We're going to talk about that in a second. But this is part of the reason, just some positive vibes, even though there's not really a whole lot of tangible evidence that we're going to see a deal.
A group of U.S. senators from the Corn Belt have reintroduced the Fertilizer Research Act. Senators Chuck Grassley, Tammy Baldwin, and Joni Ernst are leading the bipartisan legislation in an effort to highlight the factors driving fertilizer costs. The bill directs the USDA to study competition, pricing trends, and transparency in the fertilizer market. The goal is to better understand the factors behind high fertilizer costs. According to the USDA, fertilizer will account for roughly 36% of a corn farmer's operating costs this year. The legislation is endorsed by numerous farm groups, including the National Corn Growers Association and the American Soybean Association.
This is great. Love to see it. I hope they get somewhere. I doubt that they will. Chuck Grassley said this: fertilizer is one of the ag industry's biggest inputs, and family farmers across the nation are severely hurting right now due to its high cost. Yet farmers have a limited window into market fluctuations and how fertilizer prices are determined. That needs to change. Our bipartisan bill will give farmers in Iowa and across the heartland more transparency and certainty so they can better navigate production costs. I'll be the first to admit I don't know anything about fertilizer, but when I talk to people who do know things about fertilizer, like when we have Josh Linville on, he'll tell you it's a pretty opaque and non-transparent market. It really is. It's very difficult to tell what's driving prices and why retailers are pricing fertilizer the way that they are. Another quote here is from Rod LaRue, who is the president of the National Farmers Union. He said, "Farmers are getting squeezed on all sides by high input costs, corporate consolidation, and unfair markets. Fertilizer is a major part of that pressure. Studies like this increase transparency, providing a clearer picture of what's driving price and supply." So I really do hope that they get somewhere. I'm just not super optimistic. Brooke Rollins was on X yesterday talking about input costs. As a matter of fact, as new trade deals come online, there are significant inherited issues that are not sustainable, and we must take vigorous action to ensue a prosperous farm economy moving forward. She talks about the big spike in seed costs, fuel and oil costs, electricity costs, fertilizer costs, labor costs, interest expenses, which is a huge deal, up 73%. She's addressing these things, but not necessarily proposing a solution. The solution to spoil it is that they're going to send the farmers more money probably next year, and they're going to approve a package this fall. I hope there's a better solution than that. I really do, but I think that that's the solution that they're leaning toward right now.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about some of our recent premium videos?
I ran a video back in March, and I talked about the corn situation, and I went kind of in depth with regard to supply and demand, and ran a whole bunch of charts, everything from U.S. stocks to use ratio to world stocks to use ratio. And then we kind of got into the nitty gritty. Like, here's the stocks to use ratio when you combine the four top exporters of corn. Here's the stocks to use ratio when you combine only the top 5 importers of corn. Here's the China stocks to use ratio. Here's world minus China. It's pretty interesting stuff to me. And the corn situation is still tight relative to a lot of other years, based on a lot of different metrics. I had a PDF download with the charts available. I think there were like 7 or 8 of them. It's cool stuff. I found it super interesting. It's educational for me to put this stuff together because it kind of gives me a better idea and lay of the land of what the global supply and demand situation is. Chris Barron was on earlier this week talking about just how poor the farm economy is based on the budgets that he's running for his customers. And the budgets look very, very bad. And as I said yesterday, yeah, I know, like, hey, paying for a subscription to hear bad news, is that really fun? No, it's not fun, but you can be happy or informed. And in this case, if you're going to be informed, you won't be happy. If you want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation. Nobody tries to sell you anything else. Brian Splitt's going to be on Running Charts today, and it should be super interesting because the charts, to me, as we're going to look at them here in a second, appear very, very interesting.
Corn, soybean, and wheat futures advanced yesterday. The December 25 corn contract gained roughly 6 cents, settling near $4.30 per bushel, supported by a weaker U.S. dollar and the potential for a smaller than expected crop. The November 25 soybean contract gained 7 cents to close near $10.50 per bushel amid optimism over U.S.-China trade talks. And Chicago wheat futures, they rallied for the 4th straight session, boosted by signs of increased export demand.
Okay, we'll use this as an excuse to look at some charts. I have a very basic novice view of the charts. Brian's view in today's premium video would be much more advanced. Here's a corn chart, and there's a couple areas of interest above the market. You've got that gap from back in July. You'd have to get up to 432 3/4 to fill that gap. That's an area of interest. And then you've got that trend line that comes in at about 442. That's another area of interest. If the corn market, or December corn futures rather, could break out above both of those levels, I think it could mean higher prices potentially. The soybean market's been very choppy, really, for a lot of the calendar year. That area where we've peaked a couple different times, 1062 up to about 1074. That's a big area, and we've got kind of a shelf of resistance in that neighborhood. Here's Kansas City wheat, which still looks terrible, but we did have this kind of multi-week downtrend channel in place, and it appears as if we've broken out above that. Does that mean that we have to rally? No, but it looks a little bit better. This could just turn into consolidation. I'll tell you what, though, I think that the weaker dollar has, again, something to do with all of this.
Gold surged to a record high on Tuesday, climbing above $3,700 per ounce for the first time. The precious metal has gained more than 40% this year, marking its strongest annual advance since 1979 and surpassing its previous inflation-adjusted peak from 1980. Trade and geopolitical uncertainty, along with heavy inflows into exchange-traded funds, have fueled the rally. Net assets in US ETFs backed by physical gold have jumped 43% since January, while hedge funds now hold nearly half of their commodity positions in gold. Analysts expect gold to continue to climb amid stagflation risks and ongoing global instability. However, US economic growth or a rebound in the dollar could slow the rally.
Gold has been a juggernaut, up 90% since January of 2023. It's absolutely phenomenal. Mackenzie, the reasons you mentioned, this is the stuff that the news wires print, and they're correct to some extent. But the one thing that they leave out, and the real reason, in my opinion, that gold is doing what it's doing is because of the debt situation. Debt, both in the United States and globally and everywhere else, just continues to skyrocket. The U.S. continues to basically create currency. I think M2 is as high as it's ever been. And now we're going to cut interest rates into all of this. So these easy money policies, this constant creation of new currency has resulted in inflation. And gold historically has proven to be an excellent inflation hedge. So I think this has just a ton to do with just easy money policies, money printing, all of that stuff. I think the other stuff is secondary, and it's helpful to the market. Absolutely. The S&P has outperformed, or the gold rather, has outperformed the S&P since January of 2023. And I picked January of 2023 because that's kind of where we broke out to the upside if you look at this chart. But in any case, since January of 2023, gold's up 90%, the S&P is up 62%, and neither of them are bad. They're both great inflation hedges historically, but gold has absolutely outperformed.
The EPA is considering two proposals for biofuel reallocation. The proposals would shift biofuel blending requirements waived under the small refinery exemption program to larger refineries. One option would require 50% of the waived 2023 through 2025 blending requirements. The other proposal would mandate a full 100% reallocation during 2026 through 2027. Both approaches would support farmers, crop processors, and biofuel producers by addressing concerns that small refinery waivers reduce demand. The EPA will collect public comments through October 31st before issuing a final decision.
These news stories with the biofuels are just rinse and repeat. It's like every week there's something. Oh, soybean oil rallied because of this rumor, or soybean oil broke because of this rumor. The American Soybean Association appreciates EPA taking the next step to address SREs. They said that they encourage the EPA to fully reallocate waived volumes to ensure the renewable fuel standards works as Congress intended and provides certainty for farmers and biofuel producers. So there's a comment period now, and I guess we've got to wait on that. What did cattle do yesterday?
Cattle futures were lower. Live cattle were 32 cents to $1.15 lower. Feeders saw losses ranging from 20 cents down to 2.10. Box beef prices dropped substantially yesterday. Choice was down 5.91 at 392.62, and Select was down 5.63 at 373.17.
Dow Jones is up 20 points. The S&P is down about 4. U.S. dollars up just a little bit. Crude oil is down 66 cents in the October WTI at 63.86. Have a great day, guys. We'll be back on Thursday.